picture for a moment a bustling marketplace in ancient Mesopotamia nearly 4,000 years ago. Merchants haggle over sacks of grain, scribes tally inventories on clay tablets, and, at the heart of the city, grand temples rise above the commotion. These temples serve not only as places of worship, but also as some of the world's earliest banks. It is here, amid the incense and carved stone, that the story of banking begins. In those early days, the need for safekeeping was paramount. Farmers and traders entrusted their surplus grains or livestock not only to avoid theft, but also to ensure their hard-won harvest could be accessed when needed. Temples, with their sturdy walls and trusted priests, naturally became custodians of these assets. Over time, these institutions began to issue receipts for deposits, a simple but profound innovation that would echo throughout banking history. Some of the earliest forms of lending can also be traced back to these ancient temples. In Assyria, India, and Sumer, records show that temples and palaces made grain loans to farmers and merchants, often with interest. The concept of lending, it seems, is as old as civilization itself. As centuries passed, banking practices spread and evolved. By the time ancient Greece and Rome flourished, the role of banks had expanded well beyond mere safekeeping. In Greek and Roman cities, temple-based lending persisted, but private individuals and firms began to take on banking functions as well. In Rome, for instance, argentarii private money changers and lenders operated alongside temples, providing deposit and lending services. Banking was slowly shedding its sacred trappings and becoming a professional, if still somewhat precarious, enterprise. Temples remained important, especially in Greece and Rome, but the transition to private depositories marked a shift toward more formalized and secular banking systems. The story of banking is inseparable from the story of money. Early banks dealt in commodities, grain, livestock, or other goods, since coins were not yet in widespread use. But around 700 before the Common Era, the Lydians, in what is now Western Turkey, introduced the first metal coinage. This innovation was transformative. Coins were durable, easily counted, and widely accepted, making them ideal for trade and banking alike. As coinage spread throughout the Mediterranean and beyond, banks adapted, accepting deposits in metal and facilitating payments between parties. These developments set the stage for a broader and more sophisticated financial system. While temples in ancient India, Syria, and Egypt continued to serve as early banks, the risks of fraud and mismanagement were ever present. Evidence suggests that not all those tasked with safeguarding others' wealth did so honestly, and the need for oversight and trust became a constant theme in banking's evolution. In Rome, as banking became more formalized, private depositories began to outpace temple banks, reflecting a growing confidence in secular institutions and the rise of a professional banking class. The Middle Ages brought further change. With the decline of the Roman Empire, Europe's banking systems fragmented, but by the late medieval period, banking re-emerged, particularly in the bustling city-states of Renaissance Italy. Families like the Medicis of Florence and the Fuggers of Augsburg established powerful banking houses, pioneering practices that would shape the industry for centuries. These banks introduced new financial instruments, such as bills of exchange and letters of credit, that made trade across long distances safer and more efficient. The rise of merchant banks and, later, national banks signaled that banking was now an indispensable part of economic life. Meanwhile, innovations were unfolding in other parts of the world. In 10th century China, the introduction of paper money marked a revolutionary shift. While Western banks still relied on metal coins, Chinese merchants and officials began to use lightweight, easily transferable notes. This early experiment in fiat currency would, in time, become a foundational element of modern banking. By the 18th century, thinkers like Adam Smith were beginning to articulate the broader economic role of banks. Smith's invisible hand theory helped explain how banks could channel savings into productive investment, fueling economic growth. Banks, he argued, acted as intermediaries, matching those who wished to save with those seeking to borrow. This fundamental function remains at the heart of banking today. In the United States, banks are among the oldest businesses, tracing their origins to the colonial era. From the beginning, their essential roles have remained remarkably consistent, operating payment systems, safeguarding deposits, and serving as financial intermediaries by lending or investing those deposits. Over time, these core functions have been formalized and regulated, but the underlying purpose endures. At its core, a bank is an intermediary. It stands between savers, those with surplus funds, and borrowers, those in need of capital. When you place your money in a bank, you are, in effect, lending it to the institution. The bank, in turn, lends those funds to individuals, businesses, or governments. This process, known as financial intermediation, is vital for economic growth. It allows resources to flow from where they are. plentiful to where they are needed most, fostering investment and innovation. Banks also perform what economists call maturity transformation. This means they take in short-term deposits, money that can be withdrawn at any time, and make long-term loans, such as mortgages or business loans that may take years to repay. This balancing act provides liquidity to depositors, who can access their funds when needed, while supporting borrowers who require longer-term financing. In addition, banks enable liquidity transformation, turning illiquid assets, such as long-term loans, into liquid ones by allowing depositors to withdraw money on demand. Another indispensable function of banks is facilitating payments. Whether settling a debt, transferring money across borders, or simply paying for groceries, banks operate the systems that make modern commerce possible. From the earliest clay tablets to today's digital transactions, the ability to move money swiftly and securely has always been fundamental to banking. One of the most remarkable features of modern banking is the process of money creation. While it is easy to imagine that most money exists as coins and notes, the reality is quite different. Today, only about 3% of money in circulation exists as physical cash. The vast majority is credit money, created by banks through the process of lending. When a bank issues a loan, it does not necessarily hand over pre-existing cash. Instead, it creates a deposit in the borrower's account, effectively generating new money. This unique ability to create money sets banks apart from other firms and underpins much of the modern economy. This credit creation process has profound implications. It means that commercial banks, not just central banks, are instrumental in determining the money supply. Although central banks play a crucial role in setting monetary policy and regulating the system, it is the everyday lending and borrowing decisions of commercial banks that drive most money creation in the economy. Other mechanisms like central bank asset purchases or government spending also affect the money supply, but commercial bank lending is the primary engine. As banking has evolved, so too have the platforms on which it operates. From the solid walls of ancient temples to the digital interfaces of today's online banks, the basic needs remain unchanged: safekeeping, lending, and payments. Yet the methods by which banks meet these needs have grown ever more sophisticated. New technologies have transformed the way we interact with banks, but the underlying functions remain rooted in practices that stretch back thousands of years. The journey from grain loans in Sumer to modern digital banking reflects not just technological progress, but also a continuous effort to build trust, facilitate exchange, and harness financial resources for the common good. As we delve deeper into the workings of contemporary banks, it is worth remembering that their foundations are ancient, their core functions remarkably enduring, and their impact on economic life profound. Banking, in all its forms, remains at the very heart of civilization's ongoing story. Imagine the modern economy as a vast, intricate machine, one that never truly sleeps, constantly humming with the exchange of goods, services, and ideas. At its core are banks, but not all banks are the same. Each type plays a unique role, shaping the flow of money, credit, and opportunity. To understand how economies grow, adapt, and weather storms, it is essential to unravel the distinct functions of central banks, commercial banks, investment banks, and specialized financial institutions, and to see how each contributes to the larger financial system. Central banks stand apart, operating as the architects and stewards of a nation's monetary landscape. They are not in the business of serving individual customers or companies with checking accounts or mortgages. Instead, their influence is broad and profound. Central banks act as the lender of last resort, a phrase that evokes stability in times of crisis. When commercial banks face liquidity shortages or the wider economy is at risk of financial panic, central banks provide emergency funds to prevent collapse. Their deeper purpose, however, is to shape the macroeconomic environment. They set interest rates, regulate the money supply, manage inflation, and often oversee the production and distribution of a country's currency. The Federal Reserve System in the United States, for example, is a complex network of regional banks and a central governing board, responsible not only for conducting monetary policy, but also for supervising and regulating other banks, providing financial services to the government, and supporting the stability of the overall financial system. The Federal Reserve structure, with its blend of public oversight and private bank participation, reflects a careful balance between independence and accountability, designed to promote both price stability and sustainable economic growth. Commercial banks, in contrast, serve as the direct interface between the financial system and the public. Their storefronts and online portals are familiar fixtures in daily life, offering a wide range of services, accepting deposits, providing loans, processing payments, and offering basic financial products. Commercial banks come in many forms, from sprawling multinational institutions to small community banks that know their customers by name. At their core, commercial banks perform the critical function of mobilizing savings and channeling these funds into loans for households, businesses, and governments. This process is central to economic development and financial inclusion. By granting loans for everything from new homes to small business expansion, commercial banks help families build wealth and entrepreneurs create jobs. The ripple effects are substantial. Research shows that community banks in particular play a key role in fueling small business growth, supporting local job creation, and boosting rates of homeownership. These banks, often deeply embedded in their communities, are adept at understanding the needs of local borrowers and making lending decisions that national institutions might overlook. The importance of commercial banks to economic stability cannot be overstated. They provide the capital that allows businesses to invest, expand, and weather downturns. They offer risk management tools such as lines of credit that give individuals and firms the flexibility to plan for the future. Moreover, they contribute to the resilience of the wider economy by facilitating payments and acting as intermediaries between savers and borrowers. When commercial banks are well capitalized and efficiently managed, they become engines of economic growth. Conversely, instability or mismanagement in the commercial banking sector can quickly undermine confidence, restrict access to credit, and trigger broader economic disruptions. Not all financial institutions fit neatly into the category of commercial banks. Thrifts such as savings and loan associations and credit unions represent another layer of specialization within the banking system. Thrifts and savings and loan associations focus primarily on accepting savings deposits and making mortgage loans, a specialization that has tangible effects on the availability of affordable housing and broader access to homeownership. Credit unions, meanwhile, are cooperative institutions owned by their members. They often prioritize service over profit and may offer more favorable terms on loans and savings products to their member owners. Both thrifts and credit unions are subject to distinct regulatory frameworks, reflecting their unique missions and structures. The existence of these specialized institutions adds diversity and resilience to the broader financial system, ensuring that different segments of society have access to tailored financial services. Investment banks occupy a dramatically different niche in the financial ecosystem. While commercial banks focus on traditional deposit and lending functions, investment banks are the facilitators of capital markets. Their primary role is to help corporations, governments, and other large entities raise capital through the issuance of stocks and bonds. Investment banks advise on mergers and acquisitions, restructure companies, and develop complex financial products to meet the evolving needs of their clients. Unlike commercial banks, which serve the general public, investment banks typically work with large corporations, institutional investors, and high-net-worth individuals. Their revenue model is built around fees for advisory services, underwriting, and trading activities, rather than the interest earned on loans. Investment banks are also central to the process of price discovery and liquidity in capital markets. By underwriting securities and facilitating trading, they help set prices for new issues and ensure that buyers and sellers can transact efficiently. This function is vital for the efficient allocation of capital across the economy, allowing resources to flow to the most promising projects and enterprises. However, the activities of investment banks can also introduce complexity and risk into the financial system, especially when innovation outpaces regulation or transparency. The regulatory environment for investment banks is distinct from that of commercial banks, reflecting the different risks and systemic implications posed by their activities. The distinction between commercial and investment banks has historically been sharp, particularly in the United States, where regulations such as the Glass-Steagall Act once enforced a strict separation. Over time, however, the boundaries have blurred, and many large financial institutions now operate across both spheres. This convergence has brought efficiencies and new opportunities, but it has also raised questions about systemic risk and the appropriate scope of regulation. Beyond these pillars, the financial system includes a variety of specialized institutions, each contributing unique services and expertise. Brokerage firms, for example, provide investment advice and facilitate securities trading for individuals and institutions. Insurance companies offer protection against risk, helping households and businesses manage uncertainty and plan with confidence. Mortgage companies focus on originating and servicing home loans, playing a vital role in the housing market. Each of these institutions interacts with banks and with each other, creating a complex web of relationships that supports economic growth, innovation, and resilience. The diversity and specialization within the banking sector are not accidental. They are the product of historical evolution, regulatory choices, and the changing needs of society. Specialization allows institutions to develop expertise and offer products that meet the needs of specific customers or industries. For borrowers, this can mean more tailored services, better access to credit, and more competitive pricing. For the economy as a whole, a diverse mix of banks and financial institutions enhances stability by spreading risk and ensuring that no single point of failure can bring down the entire system. It is worth noting that a healthy, well-regulated banking system is widely recognized as essential to economic growth and stability. Banks mobilize savings, channel funds to borrowers, and enable the efficient operation of payment systems. They are the conduits through which monetary policy is transmitted from the central bank to the real economy. When all parts of the system function effectively, when central banks maintain stability, commercial and community banks serve their communities, investment banks allocate capital, and specialized institutions address niche needs. The result is a resilient, dynamic economy capable of weathering shocks and seizing opportunities. While the architecture of banking can appear dauntingly complex, its underlying logic is straightforward. Different institutions exist to meet different needs, and together, they keep the economy's engine running. From the central bank's lofty perch to the community bank's corner office, each type of bank plays its part in shaping prosperity, fostering innovation, and building the foundation for a thriving society. Walk into a bank branch today, or open a banking application on your phone, and you enter a world of invisible, ceaseless activity. Behind every account balance, every payment notification, and every loan approval lies a vast, intricate system. The beating heart of this world is the modern core banking system, a combination of software, data infrastructure, and regulatory oversight that together enable banks to fulfill their roles in a fast-paced, globally connected economy. At its core, modern banking is about managing information and trust at scale. When a customer deposits a paycheck, pays a bill online, or takes out a loan, the bank's core system springs into action. This sophisticated suite of software processes, transactions, updates ledgers in real time, and ensures that funds flow where and when they should. The days of batch processing, when transactions were compiled and settled overnight, are fading. Advances in technology have ushered in an era of real-time updates. The moment you swipe a card or transfer money, the change is instantly reflected in your account. The journey to today's banking infrastructure has been far from smooth. Early banks relied on local, manual ledgers, books and slips of paper prone to error and delay. Over time, these fragmented records gave way to centralized, computer-driven systems, and more recently, to cloud-native, application programming interface-driven platforms that can scale to millions of users across continents. The shift to cloud computing allows banks to update systems quickly, deploy new features, and interact seamlessly with financial technology partners and payment networks. Application Programming Interfaces, or APIs, act as digital bridges, enabling banks to connect with a growing web of external services, from budgeting applications to international payment gateways. Payment systems, once dominated by paper checks and in-person transactions, now function as digital highways. Payment instruments, cards, mobile wallets, electronic fund transfers, all feed into gateways that route information securely and efficiently. Modernization efforts have focused on making these systems more robust, flexible, and accessible. Behind the scenes, payment infrastructure has been re-engineered to process vast numbers of transactions with minimal friction, reducing settlement times and improving reliability. For individuals and businesses alike, this means that paying a supplier, buying groceries, or sending money to a family member halfway around the world is faster and less error-prone than ever before. For businesses especially, digital payment options are transformative. Automated systems streamline cash flow management, making it easier to track income, schedule outgoing payments, and reconcile accounts. Automation reduces the need for manual intervention, lowering costs and minimizing human error. The impact on day-to-day operations can be profound. Payroll can be processed with a few clicks, vendors paid automatically, and financial data integrated with accounting software in real time. The consumer experience has also been revolutionized by banking technology. Online and mobile banking platforms give customers 24/7 access to their finances from nearly anywhere in the world. Automated Clearinghouse, or ACH, transfers allow for secure electronic movement of funds between banks, supporting everything from direct deposits to recurring bill payments. Credit and debit card technology has evolved from simple magnetic stripes to advanced chips and contactless payment methods, further enhancing security and convenience. These advances are not static. Over the past 5 decades, banking technology has evolved at a relentless pace. The introduction of the magnetic stripe on credit cards in the 1970s was a watershed moment, enabling electronic processing and laying the groundwork for today's card payment systems. In more recent years, banks have begun experimenting with artificial intelligence, using generative AI to offer personalized financial advice and detect fraudulent activity in real time. Blockchain, though still in its early stages within mainstream banking, is being explored for its potential to transform how transactions are recorded and verified, offering new possibilities for transparency and efficiency. This digital transformation is more than a matter of convenience. It is fundamentally reshaping how banks operate and interact with their customers. The integration of digital technologies has become central to banking strategy. Banks are investing in automation, artificial intelligence, and customer-centric design, striving to make their services simpler, faster, and more intuitive. For example, chatbots can answer routine questions at any hour, while machine learning algorithms help flag unusual account activity, protecting customers from fraud. Of course, with great technological power comes the responsibility to protect customers and comply with regulations. Consumer protection rules govern nearly every aspect of electronic fund transfers, check processing, and account disclosures. The Federal Deposit Insurance Corporation, or FDIC, and other regulatory bodies set out clear requirements to ensure that consumers understand their rights, that electronic payments are secure, and that disputes can be resolved fairly. These frameworks are constantly evolving in response to new threats and innovations, balancing the need for security with the imperative to foster innovation. Risk management is another pillar of modern banking. Banks must safeguard not only the money entrusted to them, but also the wealth of data they collect. Technologies like encryption and multi-factor authentication are standard tools in the fight against cybercrime. Within the bank, sophisticated analytics monitor for signs of fraud, money laundering, or operational error problems that can have far-reaching consequences if left unchecked. Regulators require banks to maintain sufficient capital reserves to absorb losses and to conduct regular stress tests, assessing how they would fare under adverse economic scenarios. Safekeeping and custody services are essential, especially for large institutions and government entities. Banks provide secure storage for assets ranging from physical securities to digital certificates, ensuring that these holdings are protected from theft or loss. Custody services are distinct from investment management. Their primary function is to hold and safeguard assets, affecting transfers or loans only upon proper instruction. This separation is crucial for preventing fraud and preserving trust. For governments and large investors, banks also monitor collateral and ensure that all transactions comply with regulatory and contractual requirements. The world of safekeeping has expanded to include digital assets, such as cryptocurrencies. Federally chartered banks in the United States may now provide custody services for digital currencies, treating them as a modern extension of traditional safekeeping. This new frontier presents both opportunities and challenges, requiring banks to master new technologies while adapting established risk management practices. At a higher level, banks continue to play a central role in money creation. When a bank extends a loan, it does not simply transfer existing funds from one customer to another. Rather, it creates a new deposit in the borrower's account, effectively generating new money. This process lies at the heart of the modern credit economy and is subject to careful institutional controls. Regulatory frameworks require banks to balance the need to supply credit with the imperative to manage risk, maintain adequate reserves, and comply with capital requirements. Banks serve a diverse set of clients: individuals, businesses, and governments, each with unique needs and expectations. For individuals, the focus is on accessible, secure, and user-friendly services. For businesses, banks provide not only capital but also tools for managing payments, payroll, and risk. For governments and large institutions, banks offer specialized custodial services and facilitate large-scale transactions, often involving multiple currencies and complex regulatory requirements. All of this activity takes place in a world that is increasingly interconnected. Payment systems link banks around the globe, allowing for the seamless transfer of funds across borders. Digital interfaces make it possible for customers to manage their finances from virtually anywhere. Yet, the complexity of these systems means that trust, compliance, and risk management are more important than ever. Modern banking systems are, in essence, vast networks of trust, technology, and regulation. They must adapt continually to new threats, opportunities, and expectations. The invisible machinery that powers every transaction is both a marvel of engineering and a testament to the enduring need for reliable, secure, and responsive financial services. As banks continue to evolve, their ability to harness technology while safeguarding trust will remain the foundation of the financial system. Banking, at its core, is built on trust. Yet trust alone cannot guarantee stability or fairness in the financial system. For generations, banks have operated within a regulatory framework designed to promote safety, soundness, and consumer protection. In the United States, this framework is defined by a unique dual banking system, where both federal and state authorities share oversight, a structure that has evolved in response to shifting risks, technological advancements, and the increasing complexity of financial products and services. The regulatory landscape is constantly changing. In 2024, financial institutions face heightened scrutiny on multiple fronts. Regulators are closely monitoring liquidity and capital adequacy, requiring banks to prove they can withstand economic shocks and absorb losses. There is also increased focus on third-party risk management, especially as banks rely more heavily on external vendors for technology and essential services. The Federal Reserve, the Office of the Comptroller of the Currency, and the Federal Deposit Insurance Corporation each play distinct yet overlapping roles in this oversight. Their mission is to ensure banks remain resilient, customers are treated fairly, and the financial system as a whole avoids crisis. Operational risk is a particular area of concern. As banks modernize, their dependence on technology grows, increasing their exposure to cyber threats. The Office of the Comptroller of the Currency's latest risk review highlights credit, market, operational, and compliance risks as ongoing issues. Cybersecurity, in particular, stands out as a critical vulnerability. Attacks on core banking systems or customer data can ripple through the industry and even threaten financial stability. The Financial Stability Oversight Council's 2024 report emphasizes the need for robust cyber defenses and the resilience of depository institutions. Regulators now expect banks to maintain not only strong internal systems, but also rigorous oversight of third-party partners, especially those providing cloud services, digital payments, or data analytics. Third-party risk extends beyond technology vendors. Banks are increasingly partnering with financial technology companies to offer innovative products, from new lending platforms to digital wallets and automated investment services. These partnerships can drive efficiency and broaden access to financial services, but they also introduce new vulnerabilities. Regulators have responded with updated guidance on how banks should assess and manage risks posed by third parties, particularly regarding consumer protection, anti-fraud laws, and compliance with anti-money laundering rules. For community banks, the challenge is especially significant. They must balance the benefits of innovation with the need to maintain oversight and meet regulatory expectations. The regulatory environment is not solely about managing threats, it also shapes opportunities for innovation. The coming years are expected to bring significant changes, with 2026 anticipated as a pivotal moment for banking regulation. Policymakers are considering new rules that would update capital requirements and supervisory priorities, aiming to balance financial stability with technological progress. Some analysts suggest a more supportive approach to bank mergers and acquisitions, which could encourage consolidation and potentially improve efficiency, though the broader impacts on competition and customer choice remain debated. Regulatory compliance itself is evolving. The rise of regulatory technology, provides banks with new tools to automate compliance processes, monitor transactions in real time, and detect suspicious activity more quickly than ever before. These advances mark the early stages of a broader digital transformation in banking supervision. Banks are investing in systems that use data analytics and artificial intelligence to identify risks, flag anomalies, and generate reports for regulators. By 2024, compliance updates are frequent, reflecting the need to keep pace with evolving threats, new products, and changing consumer expectations. The interplay between regulation and innovation is perhaps most evident in the relationship between banks and financial technology firms. Financial technology companies have transformed how people borrow, save, invest, and pay, often outpacing traditional banks in deploying new technology. This has created a competitive dynamic, but also opportunities for collaboration. Advances driven by financial technology and artificial intelligence, fraud prevention, open banking, and alternative payment systems are pushing banks to rethink their business models. Some banks have responded by investing heavily in digital infrastructure, aiming to match financial technology companies' agility while leveraging their own scale and customer trust. The impact of financial technology on traditional banking is complex. Research indicates a mix of positive and negative effects. In some cases, financial technology innovation has improved profitability for banks, particularly when it increases efficiency or opens new markets. Investments in digital infrastructure have enabled banks to streamline operations, reduce costs, and serve customers more effectively. In developing economies, the adoption of financial technology has even been linked to reduced risk-taking and greater profitability among banks. However, challenges remain. Financial technology companies can erode traditional banks' market share, and rapid technological change can outpace existing oversight frameworks. This has led to ongoing debates about how best to regulate new entrants, ensure a level playing field, and protect consumers. As banks and financial technology companies converge, new forms of risk arise. Artificial intelligence is increasingly used to detect fraud, assess creditworthiness, and personalize financial advice. While these tools can enhance efficiency and accuracy, they also raise concerns about data privacy, explainability, and potential bias. Regulators are beginning to address the implications of agentic artificial intelligence systems capable of making decisions and taking actions with minimal human intervention. The adoption of digital currencies, blockchain, and embedded finance platforms further blurs the lines between banks, technology firms, and non-traditional financial service providers. These innovations offer the potential for faster payments, greater transparency, and more inclusive services, but also introduce new operational and compliance risks. Looking ahead, several trends are likely to shape the future of banking. The shift toward digital operating models will accelerate, with banks leveraging data analytics to understand customer behavior, manage risk, and develop new products. Cybersecurity will remain a top priority, not only to protect customer data, but also to safeguard the integrity of the financial system. The integration of artificial intelligence will become more widespread, driving advances in fraud detection, customer service, and risk management. Payment systems will continue to evolve, with technology-driven approaches to liquidity management, embedded finance, and real-time fraud prevention becoming standard. By 2030, some analysts envision a world of unconstrained banking, where customers interact with banks through a variety of digital channels, including voice assistants, smart devices, and decentralized platforms. Digital currencies, whether issued by central banks or private entities, may become mainstream, offering new ways to store value and transact. The boundaries between banks, financial technology companies, and technology companies will continue to blur, creating an ecosystem that is both more dynamic and more complex. Yet amid all these changes, one constant remains: the need for effective oversight. Regulation is not a brake on innovation, but its foundation, ensuring that progress does not come at the expense of stability, security, or trust. As the regulatory environment evolves, so too must the strategies banks use to manage risk, foster innovation, and serve customers in a digital age. The future of banking will be shaped not only by technological advances, but by the ability of regulators, banks, and innovators to work together in building a resilient, inclusive, and trustworthy financial system.